Good evening, everybody. And thank you for joining us today on our fourth financial literacy workshop on accounting and bookkeeping. We're glad that you could take time out of your day to join us this evening. And I'm hoping that you're looking forward to this workshop as much as I am. Today, we'll want to begin with land acknowledgement. We acknowledge that Tribe Network is located in Mi'kma'ki, the ancestral and unceded territory of the Mi'kmaq people, and we acknowledge that them as the past, present, and future caretakers of this land. Tribe Network also recognizes and honors the many nations of indigenous people who presently live on this land and those who have spent time here, and the ancestors who have hunted and gathered across this land known as Turtle Island, Canada. So for those that have not interacted with Tribe Network before, I'll just do a short introduction. So Tribe Network is a leading technology entrepreneurship and innovation hub based in Halifax, Nova Scotia. We are a community of Black, Indigenous, and people of color pursuing entrepreneurship and innovation in Canada. We provide our members access to relevant resources so they can scale their businesses and have access to relevant resources and expertise. Our signature program is the Black Startup Project, which is a unique program that provides Black entrepreneurs and business owners in Atlantic Canada with access to services and opportunities to help them scale their businesses. And we have this in 3 different stages: the start, the build, and accelerate. For start, it's for those in the early stages of their business development where they have an idea and are looking to work it out with somebody. And for build, and those are people that are in the process that are revenue generating and are looking for different ways for them to scale this revenue. And accelerate is for those that are building tech-enabled businesses and are looking to grow very quickly. So if you want to have any more information about the BSP, please feel free to speak to me or my colleague, Julia, who is also on the call. We would also like to let you know about our values, which is lead with love, nurture community, inclusive leadership, and practice creativity. And within this specific workshop, we encourage everybody to come represent their best self, be mindful of everybody else on the call. You are free to join with video or not join with video, but we do want to have more interaction on the call. I will now hand it over to Zawadi Mayeka, who is joining us on the call and will be leading this workshop.
Thanks, Katrina. I'll take over here. All right. Thanks for coming, everyone. And today we're going to go through the accounting and bookkeeping of the financial literacy workshop series. So my name is Zawadi Mayeka, and I'll just give a quick overview of everything we're going to do here today. So we'll go through an intro and the accounting cycle, looking at keeping track of business transactions, accounting principles, which all flow into understanding bookkeeping, which flows into financial statements and income statements and balance sheets. So taking things from cradle to grave. So, but first I'll give a quick introduction of myself. So my name is Zawadi Mayeka. I currently work in Moncton at a private accounting firm, Tilbury, as a manager. But prior to that, I worked in assurance at a Big Four in Newfoundland, where I obtained my BCom. So I did accounting in undergrad and started my CPA there, and mainly providing assurance services, so larger audits and reviews to multinational corporations and some locals. So now currently in Moncton, I work as a manager, as mentioned, and more to owner-operated, so people closer in structure to the businesses that you as a participants will be doing, and looking at someone who doesn't have a full time accounting staff, some do, but looking at the range of 200,000 to 50 million revenue, and some smaller than that, depending on what works, and doing the whole suite. So we do not-for-profit, we do reviews, we do engagements with all kinds of businesses, from construction to services to restaurants. So quite a wide breadth of experience, and happy to be here today. And please, throughout, feel free to stop me and ask a question. If you want to ping in the chat, Julia is going to be monitoring there. And otherwise, you can just unmute your mic and speak up. All right. So looking at the accounting cycle. So what this is referring to is how everything is recorded, and we'll take things from cradle to grave. So looking to understand, the most important thing is recording your transactions effectively, which is step one. So if you don't have good information, you can't produce a good output. So as they say, garbage in, garbage out. So high quality records will equal high quality statements and financial information, which is the most important thing when making decisions, when looking back and looking forward. So you want to post those transactions to a ledger, which would be an account. We'll go through that as a T account. Prepare a trial balance, which we'll go through in detail, which is looking at the summation of all your ledger accounts, which are then made into financial statements, which everyone who is or isn't familiar, we're looking at the normal financial statements that show how a business has performed at a moment in time and throughout a period of time. So usually a year. So keeping track of your transactions. So as starting as a small business owner, and we hope that you do scale up, you want to make sure that everything in your business, whether it's company or sole proprietorship, at the stage you are, the quality of records will determine the quality of the reports. And that goes to show, if you don't have everything organized, you can't know what's happening. So you want to build a roadmap in terms of telling a story of your business, which is what the financial statements and records are, which also are required for the tax and other reporting needs. So you want to keep everything neat and tucked. And starting with this first step, if you are buying and selling, providing a service, you want to open your business account and keep your personal banking and your business banking separate. One, it limits your liability. When CRA can come and audit things, it's much cleaner when everything for the business is set aside and it all makes sense. And it's easier for filing when you're writing checks or receiving checks and payments. A lot of businesses larger won't do business or make payments to individuals for security reasons. So if you have your business bank account with your business name on it, everything is neat and tucked. You want to select the right accounting system. So I'm sure everyone's familiar with some sort of QuickBooks or FreshBooks or Sage, or the list is endless. Some people just keep the records in Excel if they have the knowledge and know-how and time, if you want to keep things that way. So you want to have the right system, and unfortunately, like, we're going to have to go through the nuts and bolts of how bookkeeping and accounting works, but most of the things will be done by the program, but it's important to understand them from an owner-operator perspective. So then after that, you want to choose your method of how you're going to record your transactions, so your accounting method, so how you manage your process. So there's usually people just do cash accounting when you're starting out, or you are not yet required to do things in bulk in major transactions. So just as you get paid and you make payments is when you record your income and expenses. The other method is accrual accounting, which would be more required if you have a bigger business or you are have a reporting obligation to a bank. You want to manage your receipts, which is managing your expenses, and once again keeping track of everything. And thankfully now you can connect your bank account to all these programs, so it's when money goes in and out, it gives you ability to record that transaction as is needed, and you can just classify it. Any questions here? So far, nobody's unmuting, so I will move on. So yeah, we want to look at the basics of accounting principles. So I know it's interchangeable to a lot of people if you have no experience. So accounting and bookkeeping are, one feeds into the other, they're not necessarily the same. So when you're bookkeeping, you are exactly that, keeping records in terms of your business activities with supporting documentation. So looking at your bills, receipts, your invoices, your POs, that bleeds into what accounting actually is, which is a systematic process of recording and summarizing, so that your accounting records per se are the story of your organization in terms of during that moment in time, and the information will be important to the user. So when you make financial statements, we don't make them for fun, well, depending on who you are, but we make them for a user. So usually it's for the owner, for CRA, or keeping your records clean so you can file an accurate tax return, which I believe would have been discussed in a prior workshop, as well as for if you have a loan with the bank would like to see financial statements, and it has to be in the same generally accepted accounting principles, and it really is the language of business. So and everyone has a deterrence to accounting, and it doesn't seem like the most fun, but the great thing about it, everything has to make sense and balance together. So there's no here or there or great interpretation. The rules are usually the rules. We'll move on from there without any questions. So we want to think of the types of accounts that you can have in your system of your business. We have a lot of misconception a lot of times about what an asset and a liability is. If you're looking or hearing about some of these fintech influencer kind of people, but we're looking at just from the straight definition of what kind of account would lead to what kind of financial statement element from the textbook. So an asset, something that is a present resource. So think of cash or money in the bank, which are technically different things. It's controlled by your business or by you, and is a result of past events. So if I made money by selling a car, that money in my account is an asset that's from a past event. Or if I have inventory that I'm going to sell, that's from a past event. A liability, a present obligation. So that means you owe somebody. Obligation means somebody has the need to be repaid or remunerated in terms of an economic resource. So that is if you bought something from someone on credit, in terms of, let's say you do construction and you buy your supplies from Home Depot, you may not necessarily have to pay everything in cash on when you pick things up. You would likely have an account with them that you have to settle every month or 60 days. And that's where you would record that personal obligation, or a bank loan. Those are the kinds of things that I think of liabilities. Equity is the difference between our assets and liability. So it is what has been generated by the business and put into the business after deducting all liabilities. So if I have 100,000 in cash and 50,000 in liabilities, there should be around 50,000 in equity, which means ownership and investment return for the owner or shareholder. Then the other elements are, we're looking at revenue and income, one and the same, which is determined by an increase in assets. So when you sell something, you're going to get your money in, and it's caused by a decrease in liabilities, which will got an increase in equity. And these are other than contributions from the owner. So if I put money into my business, that's not revenue. I haven't bought or sold anything. I haven't changed in assets. That's just equity in there, as was mentioned. And then an expense, a decrease in assets, which would mean when you pay money out, you are decreasing assets and you are increasing expenses. Or if you increase liabilities, you would circumvently be increasing your expenses in that way. So it's outside of, once again, owner's equity in that regard. Any questions about the high level definitions about the types of accounts that we have? Nope. Here we go. So now we're going to look at the nuts and bolts of bookkeeping. For those who have some experience, like how we do the double entry bookkeeping, and the scale here is pertinent in that it does show the great thing about accounting and bookkeeping is that everything has to balance. You can't have something that's one-sided. An entry is always going to have two sides to it. So a debit has a credit, and everyone has somebody, like they say, there's somebody for everybody. So looking at just the ordinary definition, at least two accounts are impacted when any transaction is done. And when we look at debits and credits, we're just using the language in accounting records that every time a transaction is entered, there's a debit on the left and a credit on the right. And depending on the kind of account, like we just saw previously, debits increase assets, credits decrease assets, but it's the opposite for a liability. A liability is something that takes your money away or a value. And so a debit would decrease that, but a credit would increase your liabilities in that respect. So when we take this example further, looking at the kinds of accounts that are impacted, there's these nifty acronyms. We're looking at girls and we look at deal. So certain kinds of accounts, so as we said, dividends, expenses, assets, and losses are increased by debits. So with those T accounts, we'd be looking to say, oh, if you debit the expense, your expenses are going up. If you debit your assets are going up. If you debit a loss, your losses are going to go up. And in juxtaposition to that, a credit to dividends is increase. A credit to expenses we're going to decrease, and assets and such and so forth. And then looking at girls, a gain is going to be increased by a credit income. So when you make a sale, money comes to you and something has to go out to keep that balance. So we're going to debit cash, credit revenue. And in the instance of a liability, if you credit a liability, that means something came in. Either if you buy a car on credit, you debit your asset, which is a car, and you credit your liability, which is the loan. And same thing for shareholders' equity, you would debit cash and you would credit shareholders' equity. So whereas, they're increased by credits and decreased by debit. And just thinking deals and girls for which one is going to be increased by debit, which one's going to be increased by credit. This may be quite a big chunk of information, but it will make sense as we get into the examples that are about to follow. So looking at your basic transactions here, just for illustrative example, if you pay your rent, let's say you have a unit office and it obviously isn't in Nova Scotia because rent is $800. You pay your $800. So what would happen is you debit the expense and you credit your cash because money is leaving your company's bank account. So credit is going to make an asset go down and debit is going to make the expense increase. And same thing, let's say you are providing a service of washing cars. You're going to be paid $50 when you do one wash. So we increase the asset with a debit, and then our revenue, which is our income, is going to be increased with a credit. So as always, things are balanced. You notice here that the debits equal the credits. Even if there were many debits and many credits in one entry, or they should be balancing to exactly, there should be no difference in these two columns here. And finally, if we're going to illustrate a liability, you get a bank loan. So you have an obligation to repay that. So you would get the cash from the loan, which is $5,000, and then you would credit your liability of your note payable, your loan, $5,000. Once again, equal, and our asset, which is the cash that comes from this transaction, is a debit, and then a credit is going to be our liability. Is there any questions in the mechanics of how we are looking at the reporting of transactions? Okay. We will continue on. We have time for questions at the end too, if anyone has any particular examples they want to look to. So then after you've recorded all your journals, you're going to look to have a trial balance, which is what is as of the day. So at the end of your financial year or mid of the financial year, you would want to tally up all of those debits and credits in all of the accounts and come with a balance. It is a great tool. Like, wanted to make sure that everything is balanced. So notice here our debits and credits are equal in our trial balance, which is the summation of all of our accounts. And once again, we look at what is our rent expense? It's a debit. Expenses are debits. Well, our cash, if we have cash in the bank, we should see a debit balance. If someone else has money in accounts receivable, we should have 3,500, which is a debit, and we have the value of the building, which is 300,000. So that is a debit because the building is an asset, and that would have been, I guess, a result of the 350 in common stock, which is the purchase and investment to the business. And revenue, once again, we have it in credit. So after we prepare our trial balance, any adjustments which would be made from looking at a high level of the trial balance, has everything been recorded and making sure everything equals. And then that's how we would feed our information into our financial statements. So yes, this is the building blocks for your financial statements, which are going to be needed for you to know how well you did during the year and how well you're doing or plan to do if you're doing prospective ones. Any questions? If they're not, I will move into the meat and potatoes of everything, which is the financial statements. So, as you would have been a very astute practitioner or business owner, you would have recorded all your transactions early, kept all of your receipts into your accounting software of your choice, and from there, you would be able to create financial statements. So, they are prepared regularly depending on the size of the business. A lot of people go quarterly, monthly, bigger. Some of the very big multinationals are looking at a week to week. Like an Amazon, they should know what's happening week to week in terms of how they performed, and that is called in the reporting period. So it can be whether a quarter in 3 months or a single month itself, or for the year, which is the most usual. And then we're going to look at the main kinds of financial statements here. We have our statement of financial position, which is a balance sheet. We'll get into those details, but that's basically saying on the day that your financial period ended. So most financial years run in parallel to the calendar year. So as of December 31st, what is the balance? So as you know, a balance is stagnant. It's at a moment in time. So how much cash was there at the end of the year? Who owed you money? Who did you owe money? What assets, liabilities did you have? What income? Well, that's the balance sheet. Then we go to our income statement, which now technically has a longer name, our statement of profit and loss or other comprehensive income. If some of the programs you see will have that, and that's the nomenclature from the required general accepted accounting standards, like the international, the rules for accounting, basically. And then we have our statement of changes in equity, that's looking at how the ownerships, like income and shares and all of those things have been changing. We won't pay too much attention to that. We're looking more at a high level today. And then looking at a statement of cash flows, which is seeing how the business's money was used throughout the year. So you can have a change in cash that goes from 10,000 to 100,000, but those changes can be due to many different things. It could be lots of operating activity, so you made way more sales. There was more investment. You made a lot of purchases or a lot of sales of fixed equipment. So you sold your building or sold your car or bought a car. And then like looking at financing, like did you get a loan? Did you have someone invest in shares? Was there a dividend buyback? A lot of things can come from our changes in cash. So it tells a story altogether. These statements tell a story of the financial performance of the company at a moment in time and during the year. All right, our statement of financial position. This is run by our accounting equation, which means assets is equals to liabilities plus equity. So we see we have our total assets here of 90,000. Since that's big enough for everyone to see. All our liabilities, which is what we owe, what we've accrued, what we have to pay in sales tax and normal tax, and our debt, 60,000, and the equity, which is 30,000, are equal to 90,000. So the great thing about a balance sheet, it always balances. And when things aren't out of balance or look a bit wonky, that's when you have to start investigating. So looking at what our income statement is, our balance sheet is, it is exactly that as at date, so a moment in time. So like I said, it's usually December 31st, and it summarizes the balances in all your accounts and looking at how things were at a moment in time. So it could be mid-year, you could be end of year, but it is I think a picture, a still picture, a single frame. So this is the mechanics of how a balance sheet works. So when money comes out as an asset, it goes to pay a liability, things have to balance. So when an asset is created, there's a liability or equity that's going to be created. So this is the result of our income statement, our retained earnings. So as everything flows, money comes in and out, or expenses come in and out. it all has to come together in balance. So if you're out of balance and your equity and liabilities only equal your assets, then you know that there's been a misentry or you've misclassified something and your records are not correct. And you should be looking, okay, how was my balance sheet looking like? Is it very healthy? Is there lots of assets, or are we very liability heavy or very equity heavy? You want to have lots of liabilities because of the risk and all of those things. So we are going to look to make sure things are healthy and you want to run a sustainable business. So that's our balance sheet. No, any questions about this?
No, we're good to go still.
Perfect. All right, so looking at our income statement, profit and loss. So this is different from our balance sheet. This is going to be like the moving picture of what happened during the year. So in this little snapshot that we have here, we're looking at, as we can see, the money changing hands, everything that was paid for and everything that we received payment for. So we're looking at our net sales and our cost of sales. So the expenses in and out, this is throughout the periods. This will be from January 1st to December 31st. So all of the expenses, all of the operating income, our interest expense, we sold some equipment, we made a loss on it that would come out here, with the amount of tax we have to pay, and this is going to end up being our net income. So this is the story of how things happened throughout the year. This is where we see if we made money and the kind of expenses we're incurring and our ratio. So we're looking at our margins. I hear people here, gross margin, net margin, those come from dividing our gross profit by sales and our net income by sales, like looking at our margins and our turnover and our markups. So this says, like, are we actually making like lucrative business decisions? So if I'm low on income, but it seems like I'm making a lot of sales, that would be reflective of the fact that I am not charging enough, or my costs are way too high. So can I reduce my costs? And that's with things like, okay, are we paying too much wages? Are we buying from the wrong kind of supplier? Or a lot of things can be told. So this is one of the snapshots that we look at it in conjunction with everything else. So this would be our profit and loss, our income statement, which is going to determine, well, as you can see, how much tax is going to be paid and all of the moving gears. And this is where your value that you're creating is going to be showing. So the higher the income, the more value that you're adding to your costs. Excuse me. And the time goes on. Let's say you are looking to expand finance. This is where things are going to be looked at for, is this business viable? If they are to receive a loan, will they be able to repay it? They're making more money than they are spending in terms of their costs and outflows. So this is where you're going to see how you're performing throughout the year. Moving on from our income statement, we go to our statement of cash flows. So here we are looking at how the money was used throughout the year. So our inflows and outflows can differ quite significantly from year to year. And yeah, this explains the change from year one to year two, let's say from 2020 to 2021 or vice versa. So from the beginning of the year, I will be using the indirect method, which is the most common one. The direct method is actually tends to be easier, but nobody uses it, and I don't know why. So we'd start with net income and looking at operating activities. This is going to be looking at all of the things that you do in your business to generate revenue. So we're looking at how the normal expenses, depreciation or amortization, and then the changes in your inventory. So if you had more inventory this year than last year, that means you spent more money on inventory. So that would be a reduction in your cash balance. If you have more accounts receivable this year than last year, that would mean you collected less, so your AR is going to go down and decrease your cash. If you have more liabilities this year than last year, if we're looking at our accounts payable, that means this year I've delayed in paying people compared to last year, so I technically have more cash on hand. And the same thing for taxes. If I have a higher tax than last year, that means I still have that cash on hand. Investing is going to look at as we touched on before, like the purchases of big things in terms of equipment that you're going to be using if you own a restaurant. If you buy a refurbished kitchen or a new stove or fixtures and fittings, if you do construction, you're looking at your excavators, all of those kinds of things. If you buy those things, then you're going to have less cash on hand. So an increase in assets is going to cause a decrease in cash in comparison to the prior period. And in juxtaposition to that, if you sell your building, you're going to have more cash. You have less assets, you have more cash in that regard. So you bought new machinery, your cash is going to go down. You bought a new building, that brought down your cash, but you sold your old one. So all in all, you're going to have a negative net cash from your investing activities. Financing is exactly that, like putting the money into the business or taking it out. So we're looking at new loans, repayment of loans, and if you have a dividends or payment of dividends to shareholders, which would be the distribution of profits. And all of those things adding together, we get to our net cash flow, which should show our cash as at the end of the year. And I know it can be a bit finicky with the mechanics of this, and I went over it quite quickly, but just so anyone has any questions here, this is where we'd be talking about how things relate to one another, from a change in one year to a change in another. And we're looking at how the business's cash actually changed. So we had a lot more cash increase from operations, but we were decreasing our cash in terms of our investing because we bought building, sold the building. So this looks like, just looking at the story here, we would have bought a new building because the prior one was old and upgraded. So it's going to be more expensive. So all in all, we have a negative cash from investing, which isn't necessarily bad. In fact, you invest to make money. And then financing, that means we got a new loan and we paid out money, but we repaid an old loan. So within getting more cash into the business so we can meet our current cash obligations. So let's say for payroll, drawing on a credit line, a loan to buy the building, a loan to buy machinery, that would be adding money into the proverbial pot, but repayment of that loan every month, they want their money, just like a landlord. So it's going to be a monthly payment, and that's going to be your repayment and result in still a positive net cash flow for everything throughout your financing. So money was still taken out, but you borrowed some, and the business still moved in that way. Any question on the designation of things or the changes? I know the cash flow statement can be pretty finicky.
I think we don't have questions in this moment yet.
Okay. Well, now it's time for all of our questions.
Okay, so what I'm going to do is I have a few questions that we can record, and then I can stop the recording and we can be more specific if Lupsi or Stephanie has any specific questions. So I have a couple of questions. One of the first question I have is the usage of each of the 4 financial statements. So the balance sheet, the income statement, the change in equity, and the cash flow. Normally, when they come into play, like when you really use them, like
Sure. Yeah. So for I understand where it's going to be used. So think of one, they're used together to tell a full story of what's happened during the year. Is our balance sheet, let's say you have been building your business, you have your construction business, to use a simple example, and you want to get a loan. The bank is not just going to be like, here you go, here's $1 million so you can ramp things up, right? So they'd be like, okay, what kind of assets and liabilities do you have? I can even go back to the slide. So if the bank is going to be looking at the health of your business and are you highly leveraged or not, you see, okay, what is the ratio of your assets to your liabilities? So do you have a lot of things that are generating cash and value versus how much money you owe? So if I have 90,000 in total assets, but I have 85,000 in liabilities, that means I have very little equity, so I'm not making a lot of money. So the bank's going to be like, well, you look this is more risky because if you can't repay the money, then what are we going to be able to do? We're going to have to take some of your assets. That's where that collateral, so that's where that would be determined. And yes, so there's a lot of ratios and analysis that happens on your balance sheet. So, and as we said, is a moment in time. So at the end of this year, what did you have? What did you owe? And if you have a balance sheet that shows that you are not overly liquid, so if I can't repay everything that I owe and still have something enough over, then I'm in trouble. But also we want to bear in mind that if I had to repay all this 60,000, let's say today, I don't have enough cash and cash that's going to come in right away. That means that I have to wait to resell the inventory I bought. I am now I might have to sell my fixed assets and other assets. This could be like a patent or something that you own. And that's not a good sign for the bank to say, well, how are we supposed to get our money from you if you don't have enough liquidity and asset base so that we can be sure that the money that you bought is going to be repaid. So that's the main instance. And another point, we can even look at it from a not-for-profit perspective. If there's receiving lots of donations and money, like we wouldn't want to see a not-for-profit owe so much that it's looking like what's happening if it has a line of credit, let's say, just to cover its day-to-day expenses, because even though I have a lot of assets, it's not all cash, right? So if I don't have my inventory or everything that's going to be easily sold and someone wants a payment, we shouldn't have something that should be level, looking to be like falling way below the liability line. So we want to have that balance or a positive relationship between our assets and liabilities, and that's what we look to like the most for our balance sheet as to what happens throughout the year that resulted in being this way at the end of the year. How is it that we have X amount of assets versus X amount of liabilities, and then that bleeds into our equity to be like, how much has this business been making? How much has been put in by the owner into the business? So that's one point of the balance sheet. I know this answers 5, I guess, iterations of that one question. And then looking at our income statement, this is going to be used a lot of times by the owner to see where we are, if you're doing it quarterly or monthly, like how much money has come in versus how much money is going out. Are your expenses higher than your income? Then you need to make a change. So the owner is going to be your number one user. You're going to look at, once again, investors or the bank in terms of how much money is being made. And if your ratios are good, so if your gross profit is rather low, and so that means you're selling everything just a bit more than you bought it. You're not taking into account your operating expenses. So that would be just as you rent an office, you have interest expense to pay. You have to pay your workers. You have to do a lot of these things. So if your gross profit is low, you should looking, am I really going to be able to cover the other expenses that come along with it? Because it's not just, I sell cars. I have to buy the cars. No, you have to have a building. You have to be able to pay your property tax. You have to be able to do a lot of things. So you would be looking at your income statement, and everyone would be looking at your income statement to make sure that are we looking right in terms of our markup percentages? Are you making enough money, or is a lot of your money just sitting in inventory? That's what we'd use them in relation to each other. So you may have a lot of inventory, but no one is buying it, and they will show here that you have very high balances in inventory, and in relation to here, you're not really making any money. So what's really is your good that valuable? Is your inventory old? Is it overvalued? Like you're saying, it's worth 20,000. No one is buying it, so it's just sitting on your balance sheet. It should be coming through here, and you should be making money in and out. And then the biggest use, the use that everyone thinks about the most is going to be your CRA. CRA is looking at what money you made, so you can pay a fair share. I know there was a separate workshop on tax. So we know that the tax obligation, that's it is an obligation of all business owners, unless it is a not-for-profit, and you have to pay a fair share. So they're looking to see what income you made and how much tax is going to be your liability, if anything, at the end of the financial year. So that's your answer for income statement. You're looking at your performance throughout the year here, and that can be used by the users, which is, let's say, the board, the owner, We're looking at management themselves. Like a lot of big companies are looking at how much income do we have. If we have reached a certain percentage or a certain amount of income, that's when bonuses are paid out because it judges performance. And yeah, once again, your obligations to the government and the crown, you have to pay a tax in that regard. So that's when your income statement is going to be used. And then your cash flows, we're looking here, mostly used at the end of the period to see how cash is changing. You want a cash rich company, not a cash dry company, because my income statement could say that I've made $1 million, but that doesn't mean that I have $1 million in the bank, right? So things change and money comes in and out of a business for many different reasons. And income isn't, all expenses aren't actual cash expenses, and they do lag. So let's say if you're buying a car, sometimes let's say from the dealership's perspective, they don't get all money that day. They may have some cars on credit to bigger clients and all those things. So it says I made $1 million in sales because I sold the car, but I'm only getting paid 5,000 if I'm getting paid installments. So your income and your cash are going to differ, and that's the story your cash flow statement tries to tell. That okay, so you do have depreciation, which is a non-cash expense, which means that depreciation, we're looking at the value of your assets deteriorating over time. So if you buy a building in year one for 100,000, it won't be worth the same 100,000 in 10 years. So whatever loss of value is there, we kind of divide it over that period of time. It's not a real cash expense, but it just means like you've lost value. So looking at, okay, income says this, but what is the actual cash? And then the cash flow statement tells the story between all of these. And they're of course more elaborate, and we're looking at comparative. I have another PDF here that shows a more detailed set of financial statements. But yeah, so we're looking to see what was the story of the money that came in and out of the business during the year. Like, is there more inventory? If there's more inventory, that means we have less cash. So that's why we have a negative there. We have more AR. That means we didn't collect as much money. That means money has been probably left out there with our customers. But we have less AR. That means we collected more. If we have more accounts payable, that means an obligation. If I owe Stephanie 10,000 this year, I mean I haven't paid it. That means that money should be preferably still in my bank. So that's the thought process behind all of the changes, and from like the different categories. We're trying to make sense of, okay, what's happened during the year in what kind of category. So are we just in our operations, or is it investing? Like cash has changed because there was the buying and selling of a building. So you'd want to know, okay, what's happened here. How is it that our cash has gone from 37,000 to 63,000 in 1 year? Or tell us the story, and that the story is being shown by increased activity, increased investing, which decreased our cash, and then our financing activities have increased our cash balance in general. Here, adding this and this is going to give us our net cash flow of 26,000. So the cash flow statement was then used at the end of the year by, once again, the bank, the owner. And if you as a business owner, you'd want to know, where's my money going? It says here I made 5,000 this year. There's $800 in my bank account. How? And then it tells the story. You had to reinvest in terms of you needed to buy new equipment. You had higher expenses. You had more people that you owed money, or people that owed you money. A lot of things are ebbing and flowing. So that's when your cash flow statement is going to be used. It's by ownership, but management is the main user of cash flow, and then investors. Investors want to know, if I'm putting my money in here, how am I getting my money out? If you are all these are negative year after year, how is this supposedly a good investment that's going to return the cash that I put in, your return on investment, your ROI? So if there is a lower likelihood that you have the ability to finance and pay dividends to shareholders, like that shows that your unhealthy cash flow and cash flow issues. So you can have money, it could all be sitting with your customer who hasn't paid you, but so your profit says high, but your cash is low. So it tells those stories. And yeah, that's the high level. Hopefully I've answered all of your questions there.
So it's fair to say that most of the time the balance sheet helps us to get loans, like to give us a good picture of what the business and that way, like the risk in the business. The income statement helps us to see the difference in cost, so we make sure that the business is generating income. And the cash flow will help us to determine the liquidity of business and what and if there is a return on investment, like if it makes sense to do that. From the perspective, like say, we have different kind of levels of business. So we have people that has a side gig, we have people that are just starting, we have a small business and medium business. When, like, do we have to go all the way to completely financial statement right from the start, or there is a point where we say, like we don't have to be as thorough with it? Like, is there a point that I have to, as a business, I'm growing, I have to say, yeah, this is the point that definitely have to be doing my statements every year?
So, unfortunately, I have to say it depends. It's going to be different for everyone. And I know that's every practitioner's favorite thing. You can't ask a doctor or anybody a question. You're told, okay, when you make 5,000, that's when you have to start making your statements. So it's going to depend on a couple of things. One, what kind of business you're in. When you're growing, if you're just starting, it's good to get a handle on it. You don't have to go as robust as this. As I mentioned, this is for illustrative purposes only. But to say you've made a couple of thousand in cash, you would want to see, okay, where am I making my money? And thankfully, if you have any of these accounting systems like the QuickBooks, the Sage, and all those things, it makes the statements for you, so you don't have to get to a very high level, complex level to get into those things. It just has to be set up correctly the first time. So I would say I usually see compilations from the level of, if you're making 10,000 in income, people are getting compilations. Some people wait longer. I've seen some clients who are making a very, very big sum of money a year, and they have pretty shanty accounting records, but it's just high margin. So you'd want to know where your money is going from early. So if you're doing something on the side and it's still starting, that's perfectly fine. But it would be good to know, or you're going to have to know at the end of the year how much money you made if you're going to be declaring that income to CRA, which you should. So you would have to have a basic income statement, basic balance sheet for yourself if you've been buying, selling assets, if you are doing that. If you are now looking at, I would like to get a loan so I can do something. So once again, depending on your type of business, if you're taking it from part-time, can be you're providing moving services, you need a truck, you would need statements to get that loan from the bank. They won't just hand you things, right? So they need a business plan, they need financial statements. So that could be needed earlier on. If you're doing something small, you won't need a robust cash flow or anything. That's spare information for yourself. And also the cash flow there early on is auto-generated, one, and two, it just tells you where your money has gone if you've been recording everything. So in the best case scenario, if your accounting system is set up right, all of this comes out and it shows you at a moment in time. With QuickBooks, you can say, I would like to know the balance sheet for these 3 weeks, or the income statement for this 3 weeks, how much money came in and went out, and it will generate the cash flow statement for you. So I would say early on, it's good to set things up. It doesn't have to be robust where you won't have this many things. You only start paying GST when you make the $30,000 threshold. So before that, but you would want to keep your records accurate and have an income statement, because you can claim your GST that you pay back if you have a registered business, even when you aren't, collecting any. So you'll be getting 15% back of all the money you spent to make your income. I don't think that's below anybody's time limit for value of return. So like we said, like starting, having its own bank account or separate bank account where things are tracked in there, the ins and outs are good. But when you start making, a few $1,000s, 3, 4, 5, I would want to have decent clean enough records so you can file your tax return with ease, because it's easier to file a return with information that's been clean throughout the year, rather than waiting till it's going to be due June 15th for a sole proprietor. On June 10th, you're now trying to sift through a bag of receipts and records to make sure that you declare everything correctly. That's not the most efficient way of your time, and then you wouldn't have known what you've made. Is your business making money? You can't tell without proper financial records. So I'd say early on, if it's set up, then it doesn't have to be so robust. But the more you grow, like if you're making $10,000 in sales, I would definitely have at least a basic balance sheet and income statement. And the higher you go and the more funding you need, you're going to want to have, I guess, start paying attention to your cash flows and all of those things. I know it's not the cleanest answer there for you, but it's just giving food for thought that you want to make sure everything is in order, so that one, you know where you're going and you know where you've been. Gives the right kind of perception that way.
So thank you so much for the question, and thank you so much, Awadi, for going all over this information. I put in the chat our feedback form as well, the links to Katerina's 50-minute sessions as well with me if you have any questions, as well our upcoming workshops. We thank you so much for taking the time today, and well, look for your tribe. Like if you have any questions, find us in tribenetwork.ca as well, any of the social media, and have a good night. Thank you.